So you might already be aware that there were changes to the unemployment, making the first $10,200 tax-free if you're filing single and up to $20,400 if you're married filing jointly. But it's really important to make sure that you qualify. And if you don't qualify, there's still a strategy that you can use to make sure that you're maximizing your tax-free dollars. So let's go ahead and go through some tax returns. I'll show you what that looks like, exactly what you can do still in 2021 to make sure that $10,200 or the $20,400 is tax-free. But before we get into it, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, certified financial planner, helping you reach your financial goals. So I'm going to go ahead and pull up some tax software that we use to show you exactly what it looks like if you're off by a single dollar and the tax consequences behind it. And of course, what you can do to make sure that you qualify and maximize those tax-free dollars. So let's go ahead and jump right into it. So you can see right here on our tax planning software that I have it set up that we're earning $150,000 and we received $10,200 for unemployment. Now this is for married filing jointly. So if you and your spouse were both collecting unemployment, then you can get up to $20,400, which is just a $10,200 multiplied by 2 as tax-free, rather than it being added to your adjusted gross income. But it's only for those that are under $150,000 for your adjusted gross income. So I want to show you exactly what this looks like. So we have it set up as $150,000 for our W-2 income. And then you can see over here our AGI, or the adjusted gross income, adds on that extra $10,200. And that's because our adjusted gross income was above $150,000 without the unemployment compensation. And you can see the unemployment compensation over here. If we click on edit and we put in that $10,200 right there in the middle. Now, if we jump over to the tax return, and I'll show you what that looks like. This is our W-2 and it's showing in this one $150,000. And if we scroll down, we could see that our total tax liability, and I already went ahead and highlighted it, our total tax is $21,368. Now you see that there's 2 lines highlighted, and that's because we also have in this example some child tax credits up to $8,000 or $8,000 for this tax return. That's why it's dropping. But just focus on line 16 for a moment. That is our total tax liability, $21,368. Especially if it's just married filing jointly with no dependents. That number for $21,368 would drop down to line 24, and it would also show the $21,368. So what happens if we drop that income below the threshold? And that's the important part. So let's go back to our tax planning software and change our income to not $150,000, but let's drop that to $149,000. In fact, let's make it the $149,999 right below the threshold. And we'll go ahead and we'll continue. And you're going to see that our new AGI, or adjusted gross income, is $149,999. Now, the unemployment didn't disappear. It's still there, but because we're below $150,000, it's now tax-free. So let's go ahead and go back to the example and show it on the actual tax return. So if you saw before the $149,999 for the W-2, we go over here, we can see this example. So we dropped it down by $1. If we scroll down on the tax return, we can see, again, our AGI is $149,999, and then our total tax liability dropped to $19,124. So if we take those two, the difference of those two, the first one was $21,368 minus, and that second one was minus $19,124. That's $2,244 more in taxes because we were $1 below $150,000. So what can you do? This is the time that you might still be able to contribute to the traditional IRA. So if you qualify For a traditional IRA, then you can reduce your adjusted gross income. Now, let's say that you don't qualify for the traditional IRA. If you have a side hustle or if you're a small business owner, then you could possibly put that money into a small business plan like a solo 401k. So let's go back to our tax planning software really quickly and take that $149,999 and put it back to $150,000. So $150,000 means that we're over the threshold. We'll click continue. You can see that the AGI is going to jump back up. It's loading 160,200. Now, if we contribute to our traditional IRA, so that's going to be a deduction to the traditional side, that goes in pre-tax. So we'll look at the adjustments and we'll go down to our IRA and we'll make that contribution of, let's say, $1. Now, what's important to note, because this is set up as a W-2 employee, if you have a retirement plan at work, that means you will not be, in this scenario, be able to also contribute to a traditional IRA, but that doesn't mean that you don't have that option. If you don't have a retirement plan at work, you can still contribute to the traditional IRA, but if you're a small business owner or you have a side hustle, so you're going to basically file a Schedule C and technically you're still a small business owner, you could put that money into a solo 401k or another type of small business retirement plan. So let's go ahead and just say the taxpayer does not have a retirement plan and my spouse does not have a retirement plan. So we're going to go ahead and click continue and wait for it. It drops down to $149,999. So we were over that threshold of $150,000, but because we made that $1 into our traditional IRA, it got us below that threshold and saved us over $2,200 in taxes. So this is just another reason why you would want to take a closer look at your tax liability to see where it falls and to see if there's any other opportunities for you to reduce your adjusted gross income by making contributions to your retirement plan, rather than just saying, hey, here's my taxes, go have your accountant or your tax preparer just file it with whatever the scenario is without actually trying to figure out whether or not it makes more sense to put that money into the traditional side versus the Roth side. And there's one other thing to note, that you do not, according to the IRS and their recent notice, you do not need to do anything if you're below the $150,000 threshold in order to get the money back. So if you already filed your taxes and it didn't register that the $10,200 from unemployment was actually tax-free when it should have been, you don't have to do anything. But in this instance, if you were over $150,000 and you could contribute to a retirement plan to reduce your adjusted gross income, that's when you need to file an amendment and to make sure that you're getting that tax-free $10,200 and the $20,400 if both you and your spouse had unemployment, married filing jointly, in order to get that back. So again, if you're below $150,000, $49,999 or less, then you don't need to do anything. You're going to get it back in a refund, or the IRS will rectify it, fix it, and send you the check. And they seem to be doing that with a lot of different scenarios because there's been so many changes. They're looking at it and saying, if there's anything that we can do so you don't have to file another amendment, cause the IRS even more work, then they're going to get you the money. But again, in this case, if you're over that threshold, look a little bit closer, go back, do what you need to do, file an amendment, get it fixed so you qualify and make sure that you're paying the least in taxes. If you have any questions on this, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.